I'm Jeanine Poggiolini. I'm the Technical Director of the Accounting Standards Board, and I'm going to talk to you about improving the quality of financial statements in the public sector. To give you some context, we have undertaken a few reviews of entities' financial statements, whether it be the review of the presentation in the Statement of Financial Performance or a recently completed review on the amendments to GRAP 16 and 17, the results of which you can both access on our website. What I want to really speak about is our observations in terms of reviewing the quality of the financial statements and what we can really do to improve that. So I think some ideas of what we see. We really get this idea that the financial statements are seen as a compliance exercise. It's obviously a requirement of the PFMA and the MFMA to prepare financial statements, so I think many entities and preparers just have this idea that as long as they've produced a set of financial statements, they're okay. What we would really like to see is entities going back to the underlying philosophy of why it is that they prepare financial statements and really understanding the importance of financial statements in really holding government accountable and the whole democratic process. We see quite a bit that entities use the requirements in the standards as a checklist, and sort of if you have a look towards the end of the standards, you'll find particular presentation and disclosure requirements, and entities are generally happy if they work through the list and make a tick and say, yes, we've provided that information in the financial statements, without really understanding whether or not that disclosure is actually relevant to their activities and whether or not it's actually adding any value to the users of the financial statements. We also find quite a bit that entities provide immaterial and irrelevant financial information in the financial statements. So immaterial, as an example, I think financial instruments is quite a typical culprit of this, is entities that might only have a transactional bank account provide pages and pages of disclosure that's really irrelevant to the users of the financial statements, given the materiality of the bank account that they have and its importance to the overall financial statements. And we also find quite a bit of clutter. So as an example, and this is clutter and immateriality combined really, is that we see a trend as an example of entities really providing disclosure on immaterial corrections to errors rather than them being aggregated in the financial statements. I think another one is really understanding how you should be applying the standards to your financial statements in terms of what is relevance from a materiality point of view. We also see that entities provide sort of generic standardized disclosures in the financial statements, so potentially it comes from a template without any modification. And I think one that I really want to emphasize is that we see that the accounting policies in particular are not very well drafted, not very well developed, quite often just repeat the requirements in the standards themselves rather than explaining how the standard was applied to that entity's particular kinds of assets, liabilities, revenues and expenses. And I'm going to just highlight two particular examples. The one is a municipality. It's a local municipality, so provides services directly to the community. The next example is a public entity. It's in the performing arts space. And in both of these, you can see that the accounting policy is exactly the same. It's the same boilerplate that has been used. It's the same template that's been applied. And quite importantly, all that you see is really the information from the standard coming through. So explaining the definition of what property, plant and equipment is. It doesn't say what kind of assets the entity has. It would explain the recognition requirements of the standards, but doesn't explain what the particular complexity is in applying the recognition requirements for the types of assets that the entity has. Measurement, again, really just boilerplate from the standard, not explaining how assets have been measured, what sort of judgments, estimates, etc. have been applied, and just really standard disclosures being produced in the financial statements. And if you had to pick up these two sets of financial statements and you didn't know that the one was a municipality and you didn't know the one was a public entity, you would actually not be able to tell the difference between these two. You would probably think it's the same set of financial statements. So really need to have a rethink about how we approach accounting policies and improving the quality. So what do we think we need to do to affect the quality of the financial statements? From our perspective, we think we need to go back to the basics. We need to go back to the underlying philosophy of why we prepare financial statements and who we prepare them for. And for us, that's really going back to fundamentally having a look at understanding why it is that we produce the financial statements, for who, and the types of decisions that they want to make. So I think as a starter, we need to ensure that we only provide relevant information in the financial statements. and obviously specifically having a look at who the users are of those financial statements and what is relevant to them. So broadly, the users of the financial statements would be those that provide resources to the entity, as well as those that receive the entity's services and or their representatives, so Parliament or a council or a legislature, and really understanding what they want to do with the information that you are giving to them and what kind of decisions they are taking. So to understand what information is relevant, you would need to understand the users, you would need to understand what decisions they want to take. And then quite importantly, I mean, all information could arguably be relevant to an entity, but you need to understand what is material. So material is really going to tell you what is it that's going to make that information in the financial statements alter the decisions of the users of those financial statements, either in terms of holding an entity accountable for its activities and its actions, or alternatively in terms of taking decisions, for example, about resource allocations. Quite importantly, we have provided some information in our guideline on applying materiality to the preparation of the financial statements. It's a comprehensive document that really sets out some of the thought process that entities would need to consider in preparing their financial statements. It is a voluntary application at this point in time, so it isn't mandatory. And obviously the idea is that we really want entities to start improving their behaviours around the preparation of financial statements, and obviously letting practice develop around materiality in the public sector. So in terms of the guideline, just to run you through particularly what we have outlined in the guideline, is that obviously it gives you a thought process of identifying who the users are of your financial statements, which I've given you the two very broad categories as resource providers and service recipients, but really understanding what is it that you as an entity do, and really understanding who the users are of that information are going to be. Try and understand what kind of decisions they would like to take when they have a look at the financial statement. So really putting yourselves in their position, or asking them directly what is the kind of information that they need to see. And then really understanding what is material, both from a quantitative, so a rand value, and qualitatively, so what is the nature of the item. In terms of going through identifying who the users are, what information they need to make decisions, understanding what is material very broadly from your entity's perspective in terms of quantitative and qualitative assessments, then you would really move on to applying those kinds of ideas when you formulate your accounting policies, and then understanding what information you want to present and disclose in the financial statements. So as much as we have produced standards of GRAP, they only apply to material items. So your accounting policies that are aligned to GRAP will only be for those material assets, liabilities, revenues and expenses that you either want to recognize or present in the financial statements. If you have items that are immaterial, you would obviously develop your own accounting treatment. It doesn't mean that you leave information out of the financial statements. Obviously everything should be accounted for, but it's really that idea of, is it material enough to apply the standards, or is an alternative accounting treatment okay? And as a very good example, I mean, at some stage, some entities that had animals in their office park were applying the full agriculture standard to those animals, when really it was fairly immaterial in terms of the financial statements, and some alternative accounting treatment would have been sufficient. So really thinking about what we put in the accounting policies, what's material, what's going to influence users' decisions, and then obviously presenting that clearly in the financial statements. Quite importantly, what we want to do with the guideline, apart from thinking about how you apply the standards from a materiality point of view, is really documenting the process that you are following. So what we often hear is that the auditors and the preparers disagree about materiality at the end of the audit process, which is probably not the best time to have conversations about whether or not something is or isn't material. I think entities need to have a clear process that they follow from the start of the reporting period about what they think is material, design their accounting policies in accordance with that, make sure that they can get that information from their systems. Importantly, from whether or not something is material, both quantitatively, qualitatively, having that go through your various governance structures, your audit committees, etc. The auditors may in fact be part of those processes to really discuss and agree what materiality looks like for your entity long before you actually get to the financial statement preparation and the audit process. Importantly, again, just to emphasize as part of this process and sort of getting your governance structures and others on board in terms of materiality, materiality is not something that you think about when you prepare your financial statements only and during the audit process. It really is an ongoing process that you need to think about from the start of the reporting period right through to the end. The one thing that I just want to mention, the guideline does not deal with materiality from a legislative point of view. So if you are required to make any disclosures in terms of legislation, you would obviously need to apply the prescriptive legislation to deal with that. In conclusion, what we would really like to see is entities to start thinking about why it is that they prepare financial statements, thinking about who the users are, the types of decisions that they would want to take based on the information in the financial statements, and then quite important, understanding the relevance of the financial statements in terms of holding entities accountable and making sure that the right decisions are being taken about government finances.